Imagine turning just $100 into $982,817. No cap. That's exactly what happened if you parked it in the S&P 500 with dividends reinvested since 1928. Same $100 in T-bills, only about $2,474. In bonds, barely $7,000. The difference is insane. But here's the wild part. Most people never see even a fraction of that kind of growth. If you're like most people scrolling right now, you've probably stared at your bank app wondering why some folks build real wealth while you're still grinding paycheck to paycheck. You see the Forbes lists, the Lambos, the I made it posts, and you low-key wonder if it's all luck or inheritance. It's not. But here's the thing nobody talks about. There was one decision. One single decision that separates the ones who build lasting wealth from the ones who stay stuck forever. And we're gonna get to it at the very end of this video, because when I tell you what it is, it's gonna hit different. Real talk. Drop in the comments right now. Do you think wealth is mostly luck or discipline? I genuinely want to know. And honestly, before we even talk about how the real players do it, we have to look at the massive illusion everyone is falling for right now. Global wealth to income ratios have exploded. They went from about 390% back in 1980 all the way to over 625% by 2025. Private wealth dominates almost everywhere. Most people think the people holding that wealth hit the lottery or took massive, dangerous risks. But a massive 2024 State of Wealth Mobility study by Fidelity exposed exactly how they actually did it. Listen to this. 37% of them credited simply starting early. 32% said it was just consistent saving. And 40% pointed to strategic investing. No secret societies, no magic formulas, just a boring, repeatable playbook that works every single time. And low-key, a lot of you probably started somewhere similar. No rich parents, no trust fund, just a regular job and that quiet voice in your head saying, there's gotta be more than this. Here's something most people don't know about real wealth builders, dead ass. 80% of US millionaires are first generation. They didn't inherit it, they built it. They live below their means, drive normal cars, and avoid all the status symbol nonsense. They allocate way more time, energy, and money toward actually building wealth, planning 2 to 3 times more than the average high earner. Their average savings rate? Right around 20% of income. Recent 2025 data confirms the median household income for these millionaires isn't extreme. Many build on middle-class earnings through pure discipline. Married couples who stay consistent outperform everyone else. But for a minute, straight up, everything looked perfect on paper. You save a little, invest a little, and the math starts working. Nobody knew the curtain was about to drop on why so many still stay broke even when they know better. This is where it gets low-key hilarious. The people you think are rich usually aren't, and the people who actually have the money, you'd never know it. The real millionaires are self-employed or business owners who targeted very specific, profitable market niches. And they do something else that sets them apart. They teach financial independence to their kids, and they received absolutely no ongoing economic outpatient care from their own parents. This isn't just modern data. The blueprint goes all the way back to 1776, when Adam Smith wrote The Wealth of Nations. He proved that wealth comes from the productive powers of labor, specialization, and free markets. Modern data perfectly aligns with this century-old theory. Real wealth is driven by the ownership and control of productive assets, like businesses, real estate, and equities, not just high wages. If you only rely on your salary, you are playing the wrong game. Not gonna lie, if you were watching this in real time, you would have been all in. The numbers are clean. The story makes sense. It's giving main character energy. Here's the breakthrough idea that changes everything. Wealth equals cash flow surplus times investment efficiency times time. That's the equation straight from the research. Surplus is income minus expenses, what they call the gap. It's your financial superpower. Positive gap means real wealth every month. Zero or negative, you're stuck no matter how much you earn. Investment efficiency means putting that gap into low-cost, diversified assets that compound. Stocks have averaged 9.9 to 10.1% annually long-term. Small caps hit 11.74%. Real estate delivers strong total returns. Residential appreciation around 4.23%, plus income returns averaging 5.12%, which often beats stock dividends sitting at just 2.12% over the last 20 years. REITs slightly outperformed the S&P 500 from 1972 to 2019. Private equity often beats public markets over longer horizons too. Time is the real multiplier, bro. Compound interest is interest on interest. The rule of 72 shows it doubles every 7.2 years at 10%. Start at 20, putting away $200 a month at 7%, over $1 million by 65. Wait till 30, less than half. Delaying 10 years roughly halves the end result. A 20-year-old saving modestly can still reach 7 figures through compounding alone if they stay consistent. The practical math is wild. To hit $1 million in today's dollars over 25 years, you need about $800 a month at 8% return. At 7%, it's $1,000. At 6%, it's $1,200. Higher savings rate or better return, and the timeline shrinks fast. Inflation sits around 2.5%. Entrepreneurship scales this hard. Forbes data shows 2/3 of U.S. billionaires are self-made. They dominate finance, tech, manufacturing, retail, and food sectors by owning productive assets. Generational numbers are clear. Gen Z averages 32,000 invested, Millennials 173,000, Gen X 311,000. 88% now believe passive income is essential for retirement. Married couples who stay consistent outperform singles and high spenders. But there was one key insight that wasn't celebrating while everyone else was. One thing that saw something nobody else did. We'll circle back, because it ends up being the most important part of this whole story. The plan looked bulletproof, and right at that exact moment, the foundation was cracking if you ignored the daily habits and behavioral side. So how do they actually build this gap we just talked about? They don't just guess, they use rigid frameworks. The most famous is the 50-30-20 rule. That means allocating 50% of your income to needs, 30% to wants, and 20% strictly to savings or debt reduction. But the heavy hitters? They use a concept called pay yourself first. They treat their savings and investments as the very first bill paid every single month. It completely removes the psychological friction. And if you are struggling to keep track of where it all goes, there are other methods. There is the envelope budget, which is entirely cash-based. There is the zero-based budget, where every single dollar is given a specific purpose before the month even starts. And they use sinking funds, which means slowly saving up for specific large future purchases, so they never have to touch their compounding investments. And here's where I want you to actually think for a second, because this part hits different when you realize this could happen to anyone, maybe even you right now. On the surface, everything looks perfect. You're saving, investing, numbers going up. Then the dark revelation drops. Most people have zero gap. Income comes in, expenses eat it all, and lifestyle inflation keeps the gap closed. That's the true cost of habits. One $5 daily coffee habit, that's $35 a week. Multiply by 840, and you're looking at almost $30,000 lost in 10 years if that money was invested at 10%. The reports call it the rule of 194 and 840, and it's brutal. Here's something that lives rent-free in my head. The biggest threat isn't market crashes. It's your own brain. Loss aversion makes losses feel twice as bad as gains. Overconfidence makes you think you can beat the market. Herd mentality makes you buy high and sell low. These biases quietly destroy more portfolios than any recession ever could. I'm not gonna lie, I had to stop researching when that sank in. Remember that one insight I mentioned? Yeah, it was the behavioral data. It knew the whole time. Was this the system's fault or just human nature? Honestly, I'm not here to judge. You tell me in the comments. What was about to happen next? No cap. Nobody had a playbook. And the worst part? We hadn't even gotten there yet. And here is the psychological trap that destroys all of that beautiful math. We talked about behavioral data earlier. Let's break down exactly what that means, because this is where most people get completely wiped out. The pain of a financial loss is actually felt twice as acutely as the joy of a financial gain. It's a psychological flaw called loss aversion. It leads everyday investors to hold on to losing positions way too long, or worse, miss out on massive market recoveries because they are too scared to jump back in. Then you have overconfidence bias. This is when someone experiences professional success in their career and they falsely believe that translates into market-beating investment skills. It almost always leads to excessive, damaging trading. And finally, herd mentality. Following your peers or whatever the media is screaming about, which historically results in buying high and selling low. Monday, paycheck hits. Tuesday, it's already spoken for. Friday, zero left in the gap. That weekend, you're cooked. Everything collapses when the gap disappears. Liquidity ratio drops below 3 months. Debt ratio creeps over 35%. Savings rate stays zero even on 6 figures because expenses rise to meet income. Parkinson's law. And for real though, put yourself there. What would you have done? I've thought about it. Still no clean answer. Short sentences, fast pace. That's how it feels when time stops compounding for you. And that one decision I mentioned at the start? Here it is. Deciding to close the gap by spending every extra dollar instead of protecting the surplus and investing it. Something that simple. Something that devastating. To survive the fall, you need armor. And the wealthy measure their armor using 4 critical building block ratios. If you want to know if you are actually going to survive an economic crisis, check these numbers tonight. First is the liquidity ratio. You take your cash and divide it by your monthly expenses. You need to aim for a solid 3 to 6 months of runway. Second is the savings ratio. That is your monthly savings divided by your gross income. The golden rule of thumb here is 20%. Third is the debt servicing ratio. Take your total debt repayments and divide them by your net income. Your absolute maximum goal should be 35% or less. And finally, the withdrawal rate. When you finally reach the finish line and retire, your annual withdrawal divided by your total assets should be no more than 4%. That is the mathematical secret to ensuring your portfolio actually lasts as long as you do. And honestly, this story isn't just about them, it's about all of us. We've all trusted the wrong narrative. Just earn more and you'll be fine. Sometimes that's enough to stay stuck for decades. Where are they now? The ones who kept the gap open are the quiet millionaires next door, financially free, teaching their kids the same disciplined habits and watching their assets compound without constant stress. The rest? Still in the rat race with bigger salaries but no real wealth built. The wild thing is, the red flags were there the whole time in every report. They always are if you know where to look. We just didn't want to see them or admit how much control we actually have. And that hits different once it sinks in. The universal lesson? Wealth isn't luck or one big win. It's decades of disciplined surplus creation, compounded in productive assets. Live below your means to create the gap. Start early. Invest consistently in low-cost, diversified options. Own businesses or equities. Protect the gap like your future depends on it. Because according to the math and decades of data, it really does. But real talk, if you were in that situation right now, what would you do differently starting this month? Drop it in the comments. No judgment. I'm genuinely asking. If you made it this far, for real, thank you. These videos take hours of research, and I want every single one to be worth your time. If you're into real, data-backed stories with no fluff, hit subscribe. Drop your biggest takeaway in the comments. I read every one. See you in the next one. Stay disciplined. Protect the gap. Let time do the heavy lifting.